Imagine you're 25 years old and taking a 1 crore term plan until the age of 65. That's a coverage of 40 years. Now you're given two options to pay for it. Which one would you pick? Most people think limited pay is better because you finish your payments yearly and save some money. But is it really the smartest choice? Today we are going to uncover which option actually saves you more in the long run and how you can turn the difference into wealth and a smarter way to manage payments even if job security is your concern. So the feast is ready, it's time to serve. Let's first look at the numbers for both options. In regular pay option, payment term is 40 years. Annual premium is 9,400 and total premium paid for 40 years is 3.75 lakh. Whereas in limited pay option, payment term is just 10 years. Annual premium is 19,200 and the total premium paid for 10 years is just 1.9 lakh. At first glance, limited pay seems like the obvious choice because you finish your payments in just 10 years and save about 1.83 lakh. That's almost 50% less. But here's where the math gets interesting. Let's look at two scenarios to see how choosing regular pay can actually benefit you more. Scenario 1. What if you choose regular pay instead of limited pay and invest the difference? Let me explain. If you choose regular pay, your annual premium is 9,400 and limited pay it's 19,200. The difference between the two is 9,800 per year or about 800 per month. Now here's where it gets interesting. Instead of paying extra for limited pay, you can invest this 800 every month in any index fund that has historically delivered 12% CAGR. And why index funds? Index funds are low cost, reliable and have historically delivered consistent returns over the long term. Now let's see what happens after 10 years. Your 800 monthly investment grows to 1.85 lakh at 12% CAGR. So by simply redirecting that extra amount you would have paid under limited pay, you already have 1.85 lakh saved up in 10 years. Now take this 1.85 lakh and invest it in any hybrid funds that offers a moderate 10% CAGR for the next 30 years. By doing this, your 1.85 lakh grows to a massive 32 lakh by the end of 40 years. Meanwhile, under regular pay, you would have paid 2.8 lakh for 30 years. But compare that to the 32 lakh you have accumulated, you not only cover your premiums but create significant wealth for your future. But still some people might worry, I'll be paying 9,400 every year for 40 years. Isn't that a burden? Let's address that with inflation. 9,400 today will be worth 5,300 in 10 years, 3,000 in 20 years and 1,600 in 30 years and just 900 in 40 years. On top of that, think about your salary. Over the next 40 years, your income will increase significantly. So what feels like a burden today will feel like a peanuts in the future. So by choosing regular pay, you not only pay less but also build a 32 lakh corpus for your future. Scenario 2. Now let's talk about a very real concern many people have, that is job insecurity. Some of you might be thinking, I don't know what my future holds and what if I lose my job? So I want to finish my payments quickly within 10 years so that I don't have to worry about my future. This is why limited pay might seem attractive. But even in this case, regular pay can still be a smarter choice. Let's see how. We already know the premium difference between regular pay and limited pay is 800 per month. So instead of paying the higher premium, choose regular pay and invest this 800 every month for 10 years in a reliable index fund. And with a historical return of 12% CAGR, you will have 1.85 lakh by the end of 10 years. Once you have 1.85 lakh, the next step is to put it into a conservative fund that offers a stable 8% CAGR. Why conservative funds? Because if job security is a concern, you want your investments to be safe and predictable. Now here's the interesting part. You're going to use this investment to pay your premiums for the next 30 years. And here's how it works. Withdraw 800 every month from the 1.85 lakh investments. And this 800 will cover your annual premium of 9,400 under regular pay for the next 30 years. So the beauty of this is you're paying your premiums without any stress even if you lose your job or face any income issues. And here's the bonus. At the end of 40 years, you'll still have 7.35 lakh left in your account. So not only do you secure your insurance, but you also build a surplus while managing job insecurity concerns. Finally, to wrap it up, regular pay might seem like a longer commitment, but it allows you to save money, invest the difference, and build wealth. Even if job security is a concern, you can manage premiums smartly and still create a surplus. So by making small consistent investments, you turn what seems like a burden into a financial advantage. However, here's a word of caution. To get these benefits, it's crucial to stay disciplined with your investments. Simply saving the difference won't help unless you actually invest it wisely. And that's all for this video. But wait, you have seen how investing wisely can transform even small savings into significant wealth. But when it comes to mutual funds, the question is, with so many options out there, how do you pick the right ones for your goals? And that's the lead for my next video, so stay tuned. Until then, this is Sabarish signing off.